Hi there. Let's take a quick dive into valuation. A fundamental concept in finance. We'll explore what valuation is and go over some of the major methods used to determine the worth of business or asset. Whether you are beginner or just looking for a quick revision, this video has you covered. Let's get started. Valuation is figuring out how much something is worth. It looks at how much money it's making now and how much money it could make in future. Think of it as a putting a price tag on a business or an asset based on its earning potential. There are few popular ways to value a business or an asset. Here are the major ones. A DCF, relative valuation, and precedent transaction. There are others also like STOP, sum of the parts, and asset based valuation. We'll look into that later. So let's break them out. So we'll start with DCF. DCF is all about future. It calculates value of an asset based on how much cash is expected to generate in coming years. Then we discount that cash in today's value because let's face it, money in future isn't worth as much as money today, right? So to get those future cash flows, there are two main ways. One is FCFF and another is FCFE. FCFF is a cash flows available to all the stakeholders of the business, and FCFE is cash flows available to only equity holders of business. So you don't need to memorize both the formulas for FCFF or FCFE. If you get FCF for cash flows by FCFF, you can easily get into FCFE. We'll look into that later. There are four ways to uh, get your cash flows through FCFF. The first one is net income, the second one is EBIT, the third one is EBITDA, and fourth one is CFO. Let's start with net income. In net income, when you add non-cash charges, then subtract changes in working capital, then also add interest into one minus tax, then subtract the capex, the value you will get is free cash flows. And we have to do it through EBIT also. EBIT into 1 minus tax. This we call as NOPAT. It's a theoretical value that shows what will be the company's operating income if company don't have any debt. So then as normal we have to add the non-cash charges, then subtract changes in working capital and subtract capex, then we get the free cash flows. From EBITDA we have to add depreciation into tax and same drill, minus changes in working capital and changes in capex. The only difference is this number, this depreciation into tax. And from CFO, this is one of the easiest one. Just remove interest into 1 minus T and changes in capex. That's these are the four ways to get your free cash flows. And let's learn how to get free cash flow to equity from free cash flow to firm. CFE is equal to FCFF minus interest interest. So to get FCFE from FCFF, we just have to do that. FCFF minus interest into 1 minus tax minus principal repayment. So after getting our cash flows, we have to discount them to get our present value. If we discount FCFF by WACC, then we get value of firm, right? And also if we discount FCFE by what? By cost of equity will get value of equity. So hey, let's quickly practice DCF on a public company called Redgain. It's a SaaS company for hospitality business. It's basically have three uh, revenue streams. One is the martech, another is distribution, and another is DAS. You don't need to know what are these business segment right now. We are just gonna focus on valuation. We just need that company's number. Otherwise, the business model or all about the business, you don't need to understand that right now. So let's get free cash flows through FCFF and through net income particularly. So it start with net income. Then we have to add non-cash charges. Then we have to subtract changes in working capital, and then we have to add interest into 1 minus tax. Lots of time people forgot that, and they just subtract fixed capital investment. We also call it capex. So let's get our number. Net income, we gonna get it in income statement. Let's drag it. The non-cash charges, which is nothing but depreciation, and changes in working capital. For us, I have calculated changes in working capital, here. Then interest into 1 minus tax. This company is virtually debt free, so this number is very low. Where is interest? Interest into 1 minus tax, which is around 25%. We can say that roughly. And then capex. So this is a SaaS business, so its main USP is it doesn't need any too much of capex, because the whole business model is based on economic of scale. So that's why the capex numbers are relatively small. And then we get FCFF. The formula is like net income plus non-cash charges, then changes in working capital. Then changes in working capital, then interest minus tax into minus capex, right? So this is our free cash flows. Next thing we have to derive is terminal value. And what is terminal value? Terminal value represents the value of business beyond forecasted period. Means, in simpler language, business will be here for a long time and we can't forecast free cash flows for long time, right? We have to stop somewhere and derive terminal value. To derive terminal value, there are two methods. First one is perpetuity growth method, and second was exit multiple. The first one, perpetuity growth method, formula goes like terminal value is equal to free cash flows in a previous year, right? the latest forecasted period. Means in this example, FY 29-30, we can take that number divided by R minus G. R being discounting factor and G being growth. So let's derive terminal. Let's go for a terminal value. This number divided by, let's take a rate of what? Let's take a normal rate of 11 minus growth will be, long term GDP growth is 6%. So there is some mistake. Yeah, the mistake was we have to take it in percentage form. So 11% minus 6%. Yeah, this is correct value. Problem with this method is like this, in industry no one uses the perpetual growth method. In industry people usually uses EBITDA into any multiple, or like simply, let's say in SaaS business the relative multiple is price to sell, right? Price to sales, and that, let's take a industry average long term price to sales growth rate, that is 3%. So our terminal value will be this number into a exit multiple. That's it. This is very easy and industry accepted method. The next thing we have to do, decide a discounting factor. We get our cash flows, then we need a discounting factor. So let's derive cost of equity by CAPM. Current risk free rate is, I think, this. I have calculated beta, which come as a 0.78, and risk premium in India currently is around 12%. These are kind of hypothetical number, so don't rely on that. Beta, cost of equity into risk free rate plus beta into market risk premium. So this is our cost of equity. Then we need, for WACC we also need cost of debt, but fortunately this company is debt free, so cost of equity will gonna get is our WACC. So but for sake of example, let's do that also. The formula of WACC is weight of equity into cost of equity plus weight of debt into cost of debt into 1 minus t, if you haven't deducted the tax portion in cost of debt. Otherwise you don't need to get that. One sec. So formula of WACC is like cost of equity into weight of equity plus cost of debt into weight of debt, right? Yeah, every time I forgot this. So this is our WACC. Now we have to discount these cash flows through that WACC. So this is year 0. So this is year 1, year 2, 3, 4, and 5. right? Oh, why this color didn't change? One sec. Right. So WAC is how much? 10.86%. So we have to derive a cumulative discounting factor. Which is like cumulative discounting factor will be like 1 divided by 1 plus this number in bracket. I always forget this. It's to n. Our n is this. We are just now to derive that. Oh, we did oopsie. We have to freeze this number. Oh, yeah. Function key was not working. Yeah. Now, yeah, it's correct. So now we just have to discount our cash flows by our current rate. So now we have to discount our terminal value. There are two ways to discount our terminal value. And the first method is like this goes like terminal value divided by 1 plus WAC raised to the number of period we have forecasted our free cash flows, like this. Yeah, but another method is like, and this is more promising according to me. So another method is like this cumulative factor into 1 divided by 1 plus discounting rate the rationale behind this and then just multiply it, so we get our terminal value. The rationale behind this formula is like in future our WAC is gonna decrease because company is gonna be more mature and more risk free. So that's the rationale. And so now we got our discounted cash flows. Let's go to next step, which is like sum of all these present value. Then cash and cash equivalent. You know that we have to subtract cash to get our terminal value, because the rationale behind is like in equity value the cash is already got there, means equity so company is public, so people knows that this company holds this much of cash, so already the cash is factored in current equity value of company. That's why we remove cash. So cash and cash equivalent number is huge. All these SaaS and tech companies they need to have this kind of cash because industry is very competitive. They have to go for merger and acquisition anytime then, so that's why they carry so much of cash, and they don't give dividend. That's the only reason, and I think that's pretty good reason. And this company is debt free, so debt is 0. and there are not non-operating liabilities that I think we should consider. So enterprise value is gonna be minus cash. That's it. So the next thing we have to look for number of outstanding shares. That number is around 117.94 and ta-da, it's good estimated value. Wow, to compare that, is this undervalued or overvalued? Let's go look for CMP. It's 724. Oh, it's fallen in recent period. I think the latest quoted numbers are not as good as expected. It was 720, right? So it's a great buy. I don't believe that. I don't know. So let's check. Look, this model is, in any DCF model, is highly sensitive towards a discounting factor and exit multiple. Like if you choose, it's like it's above 100,000, and if I take this as a 2, I don't know, this is in the, then it's like fairly valued. So that's it. This is how we done DCF. And again, this is not any recommendation to buy or sell, and I don't think you guys should rely on these numbers. These are hypothetical number mostly all. Thank you for watching.